Imagine you put $50,000 into a growth fund at the start of last year. Your neighbor put the same amount into a different growth fund. Same stock market, same economy, same 12 months. By the end of the year, your fund is up about 25%. That feels great. Then your neighbor tells you his fund returned 45%. That's a difference of roughly $10,000 from one single year. Now multiply that gap across a full decade. That's not a rounding error. That's a retirement you can feel. Today, I'm comparing 3 of the most popular growth ETFs, QQQM, VGT, and SPMO. By the end of this video, you'll know exactly how each one makes money, how each one loses money, and which one gives you the best shot at keeping your gains when it matters most, in retirement. And here's what makes this different from every other comparison out there. I'm not just going to show you which fund had the highest return. I'm going to show you which one dropped the least when the market fell apart. That number changes everything. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. The retirement scorecard, 3 numbers that actually matter. Most people compare growth funds by looking at one number, the average annual return, and then they pick the highest one. That sounds logical, but it leaves out the number that actually determines whether you keep those returns in real life. That number is the worst year drawdown. That's how far the fund falls when the market drops. And for anyone over 50, this number matters more than everything else combined. Here's why. If your fund drops 50%, you need a 100% gain just to get back to where you started. That's basic math. But if you're retired and pulling money out during that drop, you might never recover. The math breaks. So here's the scorecard I'm using today. 3 criteria. First, worst year drawdown. How much pain can this fund cause? Second, concentration risk. How many stocks are actually driving the returns? If 3 companies make up half the fund, that's a risk most people don't see. Third, long-term after fees return. The actual number you keep. We're going to fill in this scorecard one fund at a time, and I'll show you which fund wins on each line. Let's start with the one most people assume is the safe, diversified choice. It's not as diversified as you think. QQQM is the Invesco Nasdaq 100 ETF. It tracks the 100 largest non-financial companies on the Nasdaq. You've heard of most of them: Nvidia, Apple, Microsoft, Amazon, Google. The expense ratio is just 0.15%. The 10-year annualized return, using QQQ's track record since QQQM is newer, is roughly 18 to 19% per year. That's impressive. That beats the S&P 500 by a wide margin. But here's what the name doesn't tell you. Over 50% of this fund is in technology. The top 10 holdings control nearly half the entire fund. And it holds 0 financial stocks, 0 energy stocks, 0 real estate. So when tech is winning, this fund looks unstoppable. But when tech falls, in 2022, QQQM dropped 32.5%. Think about what that means for someone who just retired. If you had $500,000 in this fund, you lost over $160,000 in 1 year. QQQM is a good fund, but calling it diversified is a stretch. It's a large cap growth bet that's heavily tilted toward one sector. Now here's where it gets interesting. The next fund has an even higher 10-year return, roughly 22% per year, but it has a number in its history that should make every retirement investor stop and think. VGT, the highest return with the highest price tag. VGT is the Vanguard Information Technology ETF. Expense ratio, just 0.09%, one of the cheapest sector funds you can buy. The 10-year annualized return is about 22%. On paper, that's the best of the 3. But VGT is 100% technology, not mostly tech, all tech. And the top 3 holdings, Nvidia, Apple, and Microsoft, make up almost half the fund. Almost half the fund rides on 3 companies. In April 2026, Vanguard did an 8-for-1 stock split on VGT. The share price dropped from $700 to about $87. Some people thought that meant it was cheaper. It wasn't. The split changed the price tag. It didn't change the risk. And the risk is real. In 2008, VGT fell over 54%. It took more than 2 years to get back to even. In 2022, it dropped nearly 30%. Let me put that in retirement terms. Say you're Frank and Linda from Michigan. You just retired with $500,000 in VGT. A 50% drop cuts that to $250,000, but you still need $50,000 a year to live. Now your withdrawal rate is 20% of what's left. That's a hole most portfolios never climb out of. Here's the myth. The fund with the highest 10-year return is always the best fund to own. Here's the truth. The fund with the highest return is only the best fund if you can survive its worst year, and most retirees can't survive a 50% drop. So, one fund dropped 32%, the other dropped 54%. The third fund, the one almost nobody talks about, dropped just 10% in that same brutal year, and its long-term return is still around 20%. Here's how. Before I show you this third fund, drop a comment right now. Which of these three are you holding, or which one caught your eye so far? I read every single comment. SPMO is the Invesco S&P 500 Momentum ETF. Expense ratio is 0.13%. It holds about 100 stocks, but the way it picks those stocks is completely different from the other two. Every 6 months, SPMO looks at all 500 stocks in the S&P 500. It ranks them by their 12-month price performance adjusted for risk. The roughly 100 stocks with the strongest, smoothest uptrends get the heaviest weights. The laggards get dropped. Then it does it again 6 months later. That means SPMO is always tilting toward whatever the market is already rewarding. It doesn't predict, it follows the evidence. And when the evidence changes, it changes too. In 2022, when tech collapsed, SPMO had already rotated out of overpriced tech stocks and into energy and healthcare. That's why it fell only 10.46%, while QQQM dropped 32% and VGT dropped 30%. Same bear market, completely different experience. Right now, after the March 2026 rebalance, technology is about 44% of SPMO, but 6 months ago, financials were over 20%. The fund adapts. You don't have to guess which sector leads next. The 10-year annualized return is approximately 20%, and the downside capture ratio against the S&P 500 is around 83 to 85%. That means when the market falls $1, SPMO typically falls only about 83 cents. Let me show you what that looks like in real life. Meet Carol and Ray from North Carolina, both 62. They have $400,000 in a growth fund and plan to pull $40,000 a year starting next year. With QQQM, a 32% drop leaves Carol and Ray with $270,000. Their $40,000 withdrawal is now almost 15% of what's left. That's brutal. With VGT at its worst historical drawdown, they'd be down to $181,000. The withdrawal jumps to 22%. That's not survivable over 20 years. With SPMO, a 10% drop leaves $358,000. The withdrawal is about 11%. Still manageable, still recoverable. The best growth fund isn't the one with the highest return. It's the one you won't panic sell at the worst possible moment. So the scorecard is filled in, but there's one more thing most people miss. Where you hold this fund matters almost as much as which fund you pick. That's what decides how much of these returns you actually keep. Let's read this scorecard together. Worst year drawdown? SPMO wins, and it's not even close. 10.5 versus 32 and 54. That's the difference between a rough quarter and a retirement crisis. Concentration risk? All three are concentrated, but VGT is the most extreme at 60% in the top 10. QQQM edges SPMO here, but the gap is small. 10-year return? VGT wins at roughly 22%, but remember, that return came with the highest drawdown of any fund on this list. SPMO's 20% is close and came with dramatically less pain. Expense ratio? VGT wins at 0.09%, but the difference between 0.09 and 0.13 is $4 a year on every $10,000 invested. That's not what's going to make or break your retirement. Downside capture? SPMO wins by a wide margin. When the market falls $1, SPMO loses about 83 cents. QQQM and VGT actually lose more than the market. So if I had to pick one growth ETF for 2026 and beyond, I'd pick SPMO. Not because it has the highest return, because it has the best combination of strong returns and smaller losses. That combination is what lets you stay invested through the bad years without blowing up your withdrawal plan. Now, where you hold it matters. If you have a Roth IRA, SPMO goes there first. Every dollar of growth inside a Roth is tax-free forever.
For a traditional IRA or a 401k, QQQM is a solid choice, low-yield, tax-deferred growth. For a taxable brokerage, QQQM or VGT work well because their tiny dividend yields create very little annual tax drag. One more thing. If you're on Medicare or close to it, watch the IRMA threshold. In 2026, if your income crosses $109,000 as a single filer or $218,000 as a married, you pay extra for Medicare. Selling a big chunk of an appreciated growth fund can push you over that line 2 years later, so if you need to take gains, spread them across 2 or 3 tax years. If someone you know is trying to figure out which growth fund to hold going into retirement, share this video with them right now. It could save them from a drawdown they don't see coming. Drop a comment and tell me, are you holding any of these 3? And which one surprised you the most? I'm curious whether SPMO was already on your radar. If you're building retirement income and want to stay ahead of changes like this, subscribe to Dividend Hustle. I cover everything that protects your income so you don't have to guess. Next week, I'm breaking down the 3 retirement accounts every smart investor fills in a specific order, and the one most people fill last is the one that should come first.